Hi, this is Doug Goldstein of the Goldstein on Gelt Show. I'm about to play for you an interview that I did with Harold Evensky. Harold is a long-time veteran of the markets. In fact, 25 years ago when I was studying to be an investment advisor, we read a lot of things that he had to say. One of the things he and I are going to talk about on this interview is the importance of realizing, and I hate to say it, that no one knows everything. People tend to be way overconfident about how they manage their money, and that overconfidence is what really messes them up. He's going to talk to us today about having a really good structure in your portfolio, and he also mentions his book, which he gives out a few copies of on the show. I got my own copy. I hope you'll have a chance to get a copy for yourself. So listen to this great interview coming up now with Harold Evensky on the Goldstein on Gelt Show.
You're listening to Certified Financial Planner Doug Goldstein, host of the Goldstein on Gelt Show, www.goldsteinongelt.com.
Okay, I'm very excited to have on the Goldstein on Gelt Show Harold Evensky, who, like me, actually is a certified financial planner, but he's been involved in it a little bit longer than I am. In fact, I often think Harold Evensky kind of is Mr. Financial Planning himself, so I'm very excited to be talking to you, Harold. You're talking to us today from Lubbock, Texas, right?
That's correct. Thank you for the nice words. It's a real compliment to be invited to participate.
Yeah, I have to tell you, since I started in the business about 25 years ago, your name has been popping up as someone that a lot of financial planners really look to for advice, but not just the financial planners who are listening to the show. I think a lot of investors who listen often listen to the good advice we give, but unfortunately, they seem to just make bad decisions. And I often attribute it to what we call behavioral finance or some other type of problem. But why do you suppose that is? Why do you suppose that people who, when they know the right thing to do, they just end up doing the wrong thing?
Yeah, you put your finger on it. The answer is because we're all human. Economists like to talk about intelligent investor, but the fact of the matter is we make mistakes because we're human. Overconfidence. I do a big lecture. How many people in the audience think at least by a fraction you're a better driver than the average? Everyone puts their head. Your kids at Lake Wobegon, all the kids are above average. But that's the way our brains work.
And how does that cause people to then mess up?
Easy. We have great overconfidence in ourselves in terms of being able to pick the best stock or fund, or overconfidence in our ability to pick the best manager, the best mutual fund. We think we can beat the system when no one else is. There's just lots of areas in which we make mistakes. So a big part of our practice is utilizing what's called framing to help people step back and maybe look at reality a little more realistically.
Yeah, I think that's an issue. Sometimes when I'm talking to clients in my day job as a financial advisor, I'll try to present a concept to them, a financial concept, but I don't use statistics and numbers and percentages because I think it confuses them. A lot of times when we're talking about risk, it doesn't help someone to talk about standard deviation, but it does help them if you say, listen, if you have $100,000 this month and next month it's $70,000, what would you do? Is that what you mean by framing?
That's exactly. Another example, someone comes in, a hot tip from their neighbor, whoever mows the lawn, and they want to take a big chunk of their money and invest. We'll say, wow, let's talk about it. If that works, you'll do great. You can take a couple of extra cruises a year. Of course, if it doesn't work, you're going to have to work 3 more years. That's framing. So one of the things is ask if you have a hot tip, all people think about, how's it going to work when it goes right? They need to stop and say, well, what happens if it goes wrong? Mm-hmm. They can frame it for themselves.
What about optimists? It's actually funny you say that because I find I am an optimist, and generally, maybe this is my personality, but it makes it difficult for a lot of people to think about the bad happening. Are we as advisors kind of forcing them to think about bad things they don't really want to think about?
I'm not sure that forcing them. I would say we're helping them think about what are the consequences. There's not 100% probability that all the good things will happen. So it's important to think about and plan for the consequences if it doesn't happen.
Why do you suppose a lot of people think when they go to a financial advisor like you or me, they say, oh, he really knows what he's doing. He can tell me how to invest. And when they say that, they're thinking something very different from what you're thinking.
Yeah, you're right. What's the best stock to buy? Should I get in? Should I get out today and tomorrow? And that's not what financial planners are all about. We basically believe investing should be boring, that risk is important as a return. We live in a 3-dimensional world, that risk and return, but expenses and taxes, that 3rd dimension. And you're not going to beat the system. The question is, how can you do reasonably well within the system and achieve your goals at a risk that you can live with?
We're speaking with Harold Evensky, who is a certified financial planner. He's actually on the advisory board of the Journal of Retirement Planning. He is formerly the chair of the CFP Board of Governors. He's probably, as I said earlier, Mr. Financial Planning himself. He's really not only helped a lot of clients, but helped thousands of advisors get involved in the world of financial planning as opposed to stock picking. And by the way, Harold said that at the end, he'll be offering 20 copies of his recent book called Hello, Harold to people who listen to today's discussion. At the end, I'll tell you how you can get it. Harold, let's dive in a little bit further to how people make decisions in a world of uncertainty and emotions. And we know it's true, as you mentioned before, the problem of being overconfident. There are many other problems that people have. If we identify these problems, that doesn't necessarily mean people aren't going to make the same mistakes. What can a serious person do who says, I want to have a successful financial future and not let my emotions get the best of me?
Great question. And the answer is structure. The key to developing and implementing, managing a portfolio is to develop what's called an investment policy statement, which is simply a really simple roadmap that says, okay, I'm going to put this much in bonds and this much in stocks, and then these kinds of bonds and stocks and these percentages, and then maintain it. And the second part of that is what's called rebalance parameters. Let's say I'm going to put half my money in bonds and half in stocks. Well, that's fine, but down the road, those percentages are going to change even if you don't touch it. Market's going to go up or down. So the other part is saying, okay, well, if it gets out of whack by more than, say, 10%, I'm going to bring it back in line again. Real simple process. And what it means is over time, investors will be doing what they say they want to do, which is selling high and buying low. The problem is it doesn't feel good because what it means is you're going to be selling what's doing well and buying what's doing poorly. Markets go down and there's a big crash and you get calls from clients saying, are we getting out of the market now? And, our job is to say, no, don't you remember? We're going to be buying now. That's a good opportunity. So it's painful, but the key is having that policy in place so that you don't let your emotions control. You kind of hold your breath and hold your nose and say, okay, well, I'm still with it. Now, that assumes over time domestic and world economy will go up and stocks will do more than bonds. That's not guaranteed, but if Armageddon comes, all bets are off anyway.
I don't know if it's Armageddon only. I think also one of the mistakes that a lot of people make when they listen to only the advice you just said, they go, okay, I can do asset allocation. I don't want to pick individual stocks. I don't want to pick individual bonds. So I'll buy some stock funds and I'll buy some bond funds. And then they shop around for the bond funds, let's say, that have the highest dividend yield. And all of a sudden they end up with a portfolio filled with what are nicely called high yield bond funds, but are really just known as junk bonds colloquially, or they'll buy long-term bond funds. And they don't even realize that the bond side of their portfolio has possibly just as much risk as the stock side.
Absolutely.
So there's a lot of risk in just not understanding how to implement it.
Oh, yeah. Now, the policy is the first step. The next is then picking the investments that go in that policy. And I couldn't agree with you more that a lot of the mistakes people make are buying stories and not buying fundamentally sound investments and not understanding it's not just the return you get, it's the risk you're taking. So you need to evaluate those two in tandem. So it's not that, high yield may not be appropriate for a little piece of a portfolio, but it's certainly not an appropriate, quote, fixed income or bond investment. It's more like a stock investment.
Mm-hmm. And so people who over the past few decades might have been following this plan, having an asset allocation model, risk, less risk, now they hit retirement and they say, oh, okay, I want to lower my exposure to the stock market and start living on the fixed income side of it. And then they discover that rates are so low. What's a good solution for people in that situation?
To recognize that they shouldn't confuse certainty and safety. Fixed income, bonds, CDs, they're certain. You know that you'll get the payment, assuming it's high quality, that you're promised. But I would go on to say it's certainly not going to be very safe. Inflation is a reality. So what they need to focus on is what we call total return. What do I think over time my investments are going to earn from dividends and from interest and capital gains? So don't focus on those pieces. Focus on how they all fit together.
All right. I think that's a great bit of advice. Harold, we are just about out of time, but in the last few seconds, just tell me, how can people follow you and follow your work?
They can go on to our website, which is evensky.com. I do every couple of months a newsletter. It's just kind of a lot of little tidbits of fun and interesting things. And we archive them on there, and they can sign up and get it from us electronically. Also, read all about our philosophy, the company, and the background of everyone that works with the firm.
Okay, we will put a link to that at the show notes of today's show at goldsteinongelt.com. And also for anyone who would like to take Harold up on the very generous offer, if you're one of the first people to contact us at goldsteinongelt.com, at the Contact Us button, just put in your name, address, and information and mention this show, we'll send you a copy of Harold's book. Hello, Harold. Harold Evensky, thanks so much for taking the time.
Well, thank you for including me. I really enjoyed it. You have a great day.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.